Welcome to Introduction to Bonds, brought to you by Canjo.com. Bonds are one of the most popular investments out there, and this video explains the basics. So let's start by understanding, what is a bond? A bond is nothing but a fancy word for a loan. At the end of the day, that's really all it is. A bond issuer is borrowing money. The amount of the money borrowed is called the principal. So if you hear about a bond with a $10,000 principal, that $10,000 is the size of the loan. In return for borrowing the money, all bond issuers will pay an interest rate. And that interest rate is predetermined. It can be paid on an annual basis or a semi-annual basis. It could be fixed or variable. But interest rates are something that are common in the bond universe. So let's now move on to the bond relationship between bond holders, the lenders, and the bond issuers, who are the borrowers. So the bond holders, the lenders, will lend the initial loan to the bond issuers. The bond issuers are borrowing money. In return, the bond issuers will repay the principal, the initial loan, plus interest over a period of months or years, whatever is predetermined by the bond agreement. So this is the relationship. Bond holders pay out an initial loan in cash up front. Bond issuers will repay that loan with interest over time. Very straightforward. Let's now take a quick look at bond prices. What are some of the things that affect the price of the bond? This is a very complex topic, and I'm simplifying a lot in this video, but I wanted to go through some of the very basics. Let's first understand how bond prices are different from stock prices. Unlike stocks, bond prices are not driven by an issuer's profitability. With stocks, profit is very, very important. Highly profitable companies usually have a stock price that's rising quickly. With bonds, it's different. Instead, bonds are determined by two factors. The two factors that determine price are interest rates and the probability of default. Now, there are other things that influence bond prices, but these are two of the big ones. So interest rates, well, that makes sense. If I'm getting more interest, if there's a higher interest rate for a certain bond than for the bond market in general, that has value because I'm getting more than I could get anywhere else. Probability of default is a bad thing. If a bond issuer is highly risky, there's a good chance he's not going to repay the loan, then the probability of default goes up. That is something that an investor would like to reduce. No one wants to lose their investment. So you're ideally looking for bonds that have a lower probability of default. Now, it's important to understand that everything has risk. This is a very simplified example, but these are some of the things that can affect the price of the bond: the probability of default and the interest rate. So thank you very much for watching this video. I hope it's helped you explain some of the basics of the bond world. And for similar videos, I recommend you check out my website, www.canjo.com.